2025 is shaping up to be the worst year in American retail history. Industry analysts from Core Site Research are predicting 15,000 store closures across the United States, which would absolutely shatter every previous record we've seen in modern retail. From major pharmacy chains to iconic department stores, from craft shops to fast fashion retailers, absolutely no sector is safe from what's happening right now. But here's what most mainstream coverage is completely missing. This isn't just a story about retail apocalypse and business failures. What we're actually witnessing is a fundamental, irreversible transformation in how Americans shop, spend money, and interact with physical retail spaces. The changes happening right now are going to reshape American communities, real estate markets, and consumer behavior for the next decade and beyond. Today, we're going to do a deep breakdown of 15 major retailers that are closing stores in 2025. For each one, we're going to examine the specific reasons behind their collapse or contraction, what went wrong with their business models, and what their closures tell us about broader trends in the economy. Then we'll zoom out and look at the big picture of what all of this means for the future. Let's dive in. Jo-Ann Fabrics and Crafts. Jo-Ann Fabrics just filed for bankruptcy for the second time, and this time there's absolutely no coming back. All 800 stores across the country are closing permanently. For millions of Americans, especially in suburban and rural areas, it was the only place within reasonable driving distance where you could buy fabric by the yard, specialty yarn, and craft supplies. The company got crushed by three simultaneous problems. First, their inventory was consistently underpriced relative to their cost structure. They couldn't charge premium prices because customers would just buy online, but they couldn't make money at discount prices because their cost structure was built for a different era. Second, consumer demand for craft supplies fell off a cliff after the pandemic boom ended. Third, they were stuck with massive fixed costs. Rent on huge retail footprints, payroll for specialized staff, utilities for giant spaces. When your sales drop 15 or 20%, but your costs only drop 5%, the math just stops working. For local craft communities, this is absolutely devastating. Jo-Ann wasn't just a store. It was a community hub where people took classes, got advice on projects, and connected with other crafters. The bigger takeaway is that specialty big box retail is fundamentally broken as a business model in 2025. Macy's. Macy's is closing 66 stores in 2025 as part of a larger strategic plan to shut down 150 locations by 2026. This is actually strategic pruning, where the company identified specific underperforming locations with high rent and aging malls, low foot traffic, and no realistic path to profitability. So rather than keep bleeding cash, they're cutting those locations and focusing on stores that actually make money. But here's the problem. When Macy's leaves a mall as an anchor tenant, it creates an immediate death spiral for the entire shopping center. Foot traffic across the entire mall drops dramatically, sometimes by 30 or 40% almost overnight. Other tenants immediately feel the impact. Smaller retailers see sales decline. Restaurants see fewer customers. Parking lots become half empty. The fundamental issue is that department stores built their entire business model on a value proposition that made sense in 1970 or 1990, but makes no sense in 2025. They offered variety and convenience under one roof, but consumers now get infinite variety online with better prices and delivery to their door in 2 days. Macy's isn't dying. They'll survive as a smaller company. But the classic American shopping mall? That's what's dying. Walgreens. Walgreens is closing 500 stores this fiscal year as part of a 3-year plan to shut down 1,200 locations total, which represents about 12% of their entire store network. This one is particularly significant because we're talking about access to healthcare and prescription medications. Walgreens went on an aggressive expansion spree in the 2000s and 2010s, putting a Walgreens on every major street corner in America. But that strategy backfired spectacularly. Stores started cannibalizing each other's sales. Meanwhile, pharmacy margins are shrinking across the entire industry. Insurance reimbursements for prescriptions keep getting tighter. The actual pharmacy business, which used to be highly profitable, is now borderline break-even for many prescriptions, especially generics. So Walgreens tried to compensate by pushing front-of-store retail, snacks, cosmetics, household items. but that doesn't generate nearly enough revenue to make up the difference. From a business perspective, closing unprofitable stores makes sense. From a public health perspective, it raises serious concerns. In rural areas and low-income neighborhoods, losing a Walgreens might mean traveling 20 or 30 miles just to pick up prescriptions. Big Lots. Big Lots filed for bankruptcy and is now selling or terminating hundreds of store leases in what amounts to a complete restructuring. Big Lots was the discount retailer where you'd go to find random deals on furniture, food, and housewares. The store layout always felt chaotic, like a treasure hunt, but the company got demolished by weak in-store sales and couldn't compete with e-commerce giants. Big Lots used to thrive on the treasure hunt shopping experience, but that entire concept has been replaced by Amazon's algorithm that serves up personalized deals directly to your phone. The conventional wisdom was that discount retail was recession-proof, but Big Lots proved that theory wrong. Being cheap isn't enough. You need efficient operations, smart merchandising, and a strong digital presence. Kohl's. Kohl's is closing 27 underperforming stores by April 2025. Despite smart moves like partnering with Amazon for returns and adding Sephora mini shops, they still couldn't save every location. What Kohl's is doing is actually a textbook example of modern retail management. They're making cold, rational decisions based on data. Each store gets evaluated on profitability, traffic patterns, and market dynamics. The stores that don't meet thresholds get closed. This is what retail evolution looks like: strategic refinement and constant optimization. These 27 closures represent surgical cuts, not panic mode. Less than 3% of their entire footprint. Kohl's is essentially pruning weak branches while strengthening the core tree. They're redirecting capital from dying locations into omni-channel capabilities and fulfillment infrastructure. The stores getting axed aren't random casualties. They're strategic eliminations based on years of underperformance and demographic shifts that made recovery impossible. Forever 21. Forever 21 is reportedly closing all 350 US stores in what marks the definitive end of an era for mall-based fast fashion. Forever 21 basically defined fast fashion for an entire generation with constantly refreshed inventory at impossibly low prices. The brand's downfall reads like a case study in disruption. Shein and Temu didn't just compete. They rewrote the rules entirely with 7-day inventory cycles instead of Forever 21's 30-day model. Gen Z abandoned malls completely, treating physical stores like museums rather than shopping destinations. Forever 21's entire revenue engine depended on impulse purchases from walk-in traffic that simply evaporated. Their 2019 bankruptcy was the warning shot, but the brand never recovered its cultural currency. And in youth fashion, losing relevance is a death sentence. The real killer was their aggressive expansion strategy from the 2000s coming back to haunt them. They locked into expensive long-term leases on enormous flagship spaces, 20,000 plus square feet in premium locations, right before consumer behavior fundamentally shifted. Those lease obligations became financial shackles when their target demographic started buying everything through social media storefronts. Forever 21 built an empire on being the cheapest option in the mall, but when the battlefield moved online, they had no competitive moat left. Claire's is closing 235 stores across North America. For multiple generations, Claire's was a rite of passage, where you got your ears pierced, bought your first jewelry, and shopped for accessories for school dances. The brutal reality of accessories retail is that profitability lives or dies on volume. With average purchases hovering around $15, a single location needs relentless customer flow just to break even on rent and staffing. When tween mall visits dropped from multiple times monthly to quarterly or less, the revenue model imploded. Private equity's leveraged buyout saddled Claire's with crippling debt right when they needed cash to reinvent themselves. That debt strangled any chance of meaningful digital investment or brand repositioning. Claire's now battles everyone from Amazon to dollar stores for the same budget-conscious accessory customer. Ear piercing was their last defensible in-person service, but even that can't justify maintaining hundreds of retail boxes. The ownership structure extracted value during good times and left Claire's financially hollow when the industry transformed. They have respectable online revenue, but it's not nearly enough to subsidize a nationwide physical footprint that no longer generates adequate returns. Torrid is shutting up to 180 stores in 2025 and pivoting hard toward a digital-first business model. Torrid specializes in plus-size fashion and built a genuinely loyal customer base. What's interesting is that this isn't about product failure or losing customer loyalty. The brand identity is solid. The problem is purely about economics. Physical stores cost significantly more to operate relative to revenue compared to e-commerce. Online margins are dramatically better because overhead is lower. Torrid represents the new retail reality. Brands aren't dying, they're migrating. The company went public in 2021, which brought shareholder scrutiny demanding immediate profitability from every channel. Physical retail became the obvious cut when analysis showed e-commerce delivering superior returns with fraction of the operational complexity. Plus-size customers historically valued in-store fitting, but improved sizing standards and generous return policies have neutralized that advantage. This is smart triage, not surrender. Torrid's keeping high performers in strategic markets while reallocating resources toward influencer partnerships and community building where their audience actually congregates. The playbook here could define specialty retail survival. Maintain a curated physical presence, invest heavily in content and social engagement, and build brand loyalty through authentic representation rather than convenient locations. If executed well, Torrid emerges leaner, more profitable, and better positioned than competitors still bleeding cash on unnecessary storefronts. Rite Aid filed for bankruptcy again and is closing 1,240 stores in what's probably the final chapter for America's third largest pharmacy chain. At its peak, Rite Aid operated over 4,500 stores. For a company that's been around since 1962, this is a spectacular collapse. Pharmacy retail has evolved into a winner-take-all industry where scale determines survival. CVS and Walgreens command thousands more locations, giving them overwhelming leverage in insurance negotiations and supply chain efficiency that Rite Aid couldn't remotely match. Rite Aid got financially gutted by opioid litigation exposure, billions in potential liability that scared away anyone who might have provided rescue capital. They nearly escaped through a 2015 Walgreens merger, but regulators killed the deal on antitrust concerns. That rejection sealed their fate. The business model itself shifted underneath them. Mail-order prescription services and in-grocery pharmacies obliterated the standalone drugstore concept Rite Aid was built on. Failed expansion attempts loaded them with suffocating debt right as industry margins compressed across the board. They ended up trapped in no man's land. Too small to compete on efficiency, too large to be nimble, and too broken financially to transform. Now rural communities face genuine healthcare access problems as these pharmacies vanish, creating prescription deserts that disproportionately hurt elderly and low-income populations. Hudson's Bay Company is liquidating all of its department stores, which marks the end of a retail institution that operated for over 350 years. Hudson's Bay was founded in 1670 as a fur trading company and evolved into one of North America's oldest and most iconic retailers. A 350-year survival streak ending in the smartphone era tells you everything about the velocity of modern disruption. Hudson's Bay successfully transformed multiple times across centuries, from fur trading to general merchandise to full department stores. But this pivot required reinvention at a speed the organization couldn't achieve. They made catastrophic financial decisions, including liquidating valuable real estate holdings for short-term cash, destroying one of their few remaining asset bases with genuine worth. Department stores promised convenient one-stop shopping, but contemporary consumers actively reject that concept. Today's shoppers want hyper-specialized curation, not broad general selection. They want algorithmic recommendations, not wandering through departments hoping to discover something appealing. Hudson's Bay kept executing a 1990s playbook: massive inventory, seasonal sales events, anchor store positioning, while consumer expectations reset around instant gratification, endless choice, and frictionless delivery. The company had history and nostalgia, but neither pays rent or moves inventory in an algorithm-driven commerce landscape where 2-day shipping is the minimum acceptable standard. Party City is closing all 700 locations after filing for Chapter 11, bankruptcy. For decades, Party City was the automatic destination for birthdays, holidays, and celebrations. But Amazon completely decimated the party supply market. Why drive to Party City when you can search Amazon for exactly what you want and have everything delivered in 2 days. On top of competitive pressure, Party City was carrying massive debt loads from private equity buyouts. Then COVID dealt another devastating blow by shutting down parties and celebrations entirely. Revenue collapsed overnight, and demand never fully recovered to pre-COVID levels. The brand might get licensed out, but the physical store network is completely done. At Home filed for Chapter 11, bankruptcy, and is closing dozens of stores. At Home operated massive warehouse-style stores filled with home decor and furniture at discount prices. But the model collapsed because they couldn't deliver enough value on either the experience side or the price side. Consumers increasingly get home decor inspiration from Pinterest, Instagram, and TikTok, then buy directly from online brands or order from Wayfair and Amazon. At Home suffered from lack of differentiation. Without clear differentiation, they became purely a convenience play. And convenience doesn't justify driving to a massive warehouse store when you can shop online. GameStop is closing stores at an accelerating pace. Physical game retail is dying as a viable business model. Digital game downloads now dominate the market, with 70 to 80% of new games purchased digitally rather than as physical discs. Console manufacturers are pushing extremely hard toward digital distribution because it's vastly more profitable. GameStop built its entire business on physical game discs and used game trade-ins, but digital distribution completely broke that model. The company got a temporary lifeline from meme stock mania in 2021, but it didn't solve the core problem. This is digital disruption in its purest form, new technology eliminating an entire retail category. Carter's is closing 150 stores over the next 3 years. Carter's is actually a strong brand in children's apparel, but they massively overexpanded during growth years in the 2000s and 2010s. What they're finding now is wildly inconsistent performance across their store base. On top of overexpansion, consumer behavior for children's clothing has shifted dramatically toward online purchasing. Parents are incredibly busy, and the convenience of ordering kids' clothes online is just objectively better than dragging kids to a store. Carter's isn't failing as a brand. They're optimizing their physical footprint to match where profits actually exist in modern retail. Dollar Tree. Family Dollar. Dollar Tree is closing 370 Family Dollar stores in 2025 as part of an ongoing rationalization. Dollar Tree acquired Family Dollar in 2015 for over $8 billion, but the integration never worked as well as hoped. The core problem is that Dollar Tree and Family Dollar serve similar demographics and often ended up with overlapping coverage. In some areas, stores were within blocks of each other, essentially competing for the same customer base and cannibalizing each other's sales. What's particularly notable is that this demonstrates that no retail segment is completely immune. Even budget retailers need to constantly optimize their footprints and eliminate underperforming stores. The big picture. CoreSite Research predicts 15,000 US store closures in 2025, an all-time record. To put that in perspective, 2020 saw about 9,000 closures. 2017, which was called the retail apocalypse at the time, saw about 8,000 closures. We're looking at nearly double those numbers. 3 major forces are driving this wave. First is inflation and rising operating costs. Rent, labor, utilities all increased dramatically. Many retailers are locked into long-term leases signed when their businesses looked completely different. Second is the massive acceleration in e-commerce adoption. E-commerce penetration jumped from 16% of total retail in 2019 to over 22% by 2024. Physical retail went from being essential to being optional. Third is the private equity and debt overhang. Companies like Rite Aid, Party City, Claire's, and Joann Fabrics are all carrying massive debt loads from leveraged buyouts. When sales softened and interest rates increased, the debt service became impossible. But here's the critical point. This is not the end of retail as an industry. Physical stores aren't disappearing entirely. What we're witnessing is a massive strategic correction where retail is right-sizing to match actual consumer demand in 2025. Some closures represent total business failures, but many others represent successful companies making smart decisions to optimize their footprints. Retail is evolving toward dramatically smaller physical footprints combined with digital-first strategies and true omnichannel experiences. The stores that survive will be more experiential, more focused on services you can't replicate online, smaller, more efficient, and located in better markets. And the vacated retail real estate isn't sitting empty forever. In many markets, it's being backfilled remarkably quickly. Medical offices and urgent care centers are moving into former retail spaces. Fitness centers are taking over big box stores. Distribution centers are using retail spaces for last-mile delivery. Mixed-use developments are converting dead malls into apartments, offices, and entertainment venues. Some communities will definitely struggle with the transition. The job losses are real, and they hurt real people and families. But the overall arc of this story is about transformation and adaptation, not permanent decline. American retail isn't dying. It's changing to match how Americans actually want to shop in 2025. The retailers that survive will be leaner, smarter, more digital, and more focused on delivering genuine value that justifies a physical store visit. The real estate that gets repurposed will create new economic opportunities, and consumers will benefit from shopping experiences that actually match their preferences, rather than being forced into outdated retail formats. So that's the full picture. 15 major retail chains closing thousands of stores, affecting tens of thousands of jobs and communities across the country. 2025 is definitely a painful and disruptive year for American retail, but it's not the apocalypse that headlines might suggest. It's a necessary correction and transformation that's reshaping how Americans shop and how retail businesses operate. Out of this disruption, new models and new opportunities are going to emerge. Retailers that adapt will come out stronger. Real estate will find new uses. And consumers will benefit from retail experiences that actually match how they want to live and shop in the modern world. If you found this breakdown valuable and want to understand what's really happening in the economy beyond the headlines, hit that like button. Drop a comment with which closure surprised you most, or how these changes are affecting your community. And subscribe for more deep dives where we cut through the noise and explain the economic forces actually shaping our lives. Thanks for watching. Stay informed. And remember, change is inevitable, but it's not the end. The future of retail is being written right now, and it's going to look very different from what we've known, but it's still going to be vibrant and essential to American life.